Okay, what did we cover last week? As usual, I'd like to do a brief recap before we start in materials. So what did we cover last week? Anybody can tell me some of the topics? Definitely in chapter 17, right?
Yes.
And that would include... Sorry?
We're working on direct labor costs and indirect costs. That was like the next thing that we did.
Okay, so we had direct labor costs, materials, manufacturing overhead, and more specifically we're working on not just classifying the costs, but trying to journalize them. We understand the general flow of cost in the system. When the production line starts, we start from purchasing materials. Remember this last Tuesday we talked about this first journal entries. When we purchase in materials, we debit materials inventory account. Right? On the credit side, obviously, if it's not cash directly, it will be accounts payable. So this is the first journal entry we covered in chapter 17. Understanding the first step, the production line, capturing and getting more resources in order to start the production line, materials. So the materials part, after we get the materials, when we start producing the products, we need to transfer them into either work in process or manufacturing overhead. And what's the difference?
Work in process for direct
Work in process is for direct materials. Manufacturing overhead, indirect materials. Okay, so remember, first type of cost is the materials cost. Second type is labor. Third type, indirect cost. At the end, all of these flows into work in process. So this is the first step. Using materials to transfer them into work in process or manufacturing overhead. Third entry, when we hire people to help us assemble the products. Of course, we have janitors' salary as well, plant managers overseeing the manufacturing site. All these salary payable, we also classify them into either work in process or manufacturing overhead. And again, the difference, direct labor into work in process and indirect labor into manufacturing overhead. Okay? First two types of costs. So what's the next one? We have first entry, purchasing materials. Second entry, using materials. Third entry, taking care of salaries for different types of employees. What's the third? Fourth, I'm sorry.
Manufacturing.
The manufacturing overhead. We need to transfer a portion over to work in process, and this is the part that we need to estimate. Right? Remember, manufacturing overhead cost, utility, rental expense, indirect materials, indirect labor. All these costs together, we only know the actual number when it comes to year end. So as the job order is being produced, being generated, we need to assign a portion of the cost to it based on estimation. So how do we do that? We will have to predetermine a rate, right? So can anybody tell me how do we determine this rate? Manufacturing cost. Manufacturing overhead cost based on estimation, right? Divided by labor hours. Either labor hours or machine hours, direct labor cost, depends on the problem, right? So this is an estimation of the allocation base. Would be direct labor hours, machine hours, direct labor cost, estimated total of what would occur in this season or this year. So after we predetermine this rate, what happens?
And the cost we divide the amount of units produced.
The units we produce, well, this is the rate based on per labor cost, per dollar labor cost or per hour machine cost, and how much indirect cost incurred compared to the labor hours or labor cost, right? So after we predetermine this rate, we want to know how much flows into a particular job order based on how many, the unit that actually occurred for this job, right? So it would be, for example, 100 hours of labor hours working, 100 machine hours, where the labor cost $1,000, then you multiply by this 40% rate to get the total overhead cost and flow it into work in process. Right? So the fourth entry we need to take care of is the manufacturing overhead cost, is this entry. We credit manufacturing overhead. A portion of this falls into work in process, so we can total up what is the halfway done cost in the manufacturing site. Later on, capture what is the fully done finished goods cost. Okay, so this is the fourth entry. First, we have materials purchased. Second, we transfer them into different categories. Labor cost, again, different categories. Then we have manufacturing overhead cost, calculated based on a predetermined estimation rate, multiplied by actual quantity occurred for this job. So each job manufacturing overhead cost is different based upon the actual quantity incurred. Okay, and then we have a few more entries to go, which is related to the finished goods. So assuming at the end we have finished goods, this dollar amount completed for this particular job, we transfer it over to inventory account, finished goods inventory. So we credit work in process inventory because this account only represents goods that are not yet completed. So the dollar amount you see at year end is the halfway done inventory. We transfer the fully completed one into finished goods inventory by debiting finished goods, crediting work in process. We covered this last Friday. Okay, so this is almost the end of the cost flow process. The last portion will be capturing sales and also the cost. Is this the end?
No, gotta over allocate.
We have one more entry in case we have under allocation or over allocation, right? Which most likely is the case because remember this is a predetermined rate, an estimation. Least likely it will be exactly the same as the actual number. So the difference is here, $5,400, we need to do something about it. So if we underassign the manufacturing overhead cost along the year, we need to assign more to cost of goods sold at year end to capture the fact that we have underestimated the manufacturing overhead cost. Okay, so we compare the debit against the credit. The credit side is lower. That means we underallocated the cost. The credit side is higher. That means we overallocated the cost. So for under allocation, over allocation, these are the two entries we would do at year end. Under allocation means we assign two less of manufacturing overhead costs in each and every job order. So now we want to assign more cost to cost of goods sold altogether at year end. This year, over allocation, we assign too much indirect cost in each job orders. We want to take some of the cost back. So we reduce cost of goods sold by cutting this. And then this account here, we basically close it out, zero it out. Okay, so this pretty much sums up what we did in Chapter 17. Production line starts with materials, then we add in labor costs, take care of manufacturing overhead based on the estimation rate, assign these to work in process, capture the amount of work in process that actually is completed, transfer this to finished goods. Finished goods is ready for sale to customer. Once we make sales orders, once customers make purchase orders, we sell them out, transfer a certain amount into cost of goods sold and sales. Okay, at year end, after many job orders being made, at year end we compare manufacturing overhead accounts, the differences between the debit and credit side. So this is the part that is readily assigned. You want to know the difference between these two amounts and adjust it based on either of these entries. Okay, questions on Chapter 17? Okay, let's work on a few problems before we end this chapter. I want to make sure we're on the same page. So here's a problem for you. Would an advertising agency use job order or process costing? What about a cell phone manufacturer? We talked about the general idea of this chapter. We're trying to focus on job order costing. Another way to take care of costs is process costing, which is in the appendix of this chapter. If we have time at the end of the semester, we'll come back to this. I don't want to confuse you between these two methods at this stage. Okay, so we have been focusing on job orders, which is used especially for companies that has more specialized, more customized orders. Remember, your order may be different from mine. So we have to capture the cost for each and every order, which is different between customers because we're not massively producing identical products. Okay? So massively producing identical products would be cell phone or advertising agency. Would be cell phone would be massively producing identical products available for customers to purchase. Advertising agency depends on company's request. Okay? They design your order differently. So this would be the last one. Advertising agency using job order systems. Each and every case is different. You cost them differently. You charge customers differently. Manufacturing for cell phones or other beverages, Coca-Cola, Pepsi, Procter & Gamble's products, you may easily find them identical in each and every types of grocery stores. As long as the brand name is the same, the type is the same, we're pretty much ensuring that the quality of the product is the same. It's usually not customized. These are process costing systems. So if you're interested in this system, you can take a look at appendix, but this will not be covered in the term. So don't worry about this for now. If we have time, we'll come back to this method. Okay, next question. When a manufacturing company uses direct materials, it assigns the cost by doing what?
Work in process inventory.
Uses direct materials flows into work in process. So the debit side is work in process, the credit side will be overhead.
Materials and everything.
Will be materials, using materials, right? So we decrease assets, turn it into another type of asset account, work in process inventory, when we use the materials. So what if this question is purchasing materials? What do we debit? Materials inventory, and we credit
Accounts
or
payable.
accounts payable or cash, depends on how we paid. Good. Next one, what if we use indirect materials? We'll be debiting manufacturing overhead. It's an indirect account. This is the account that captures all the indirect costs. Okay. If we use direct labor, which account will capture your salary?
Wages paid.
Wages paid.
We will be debiting directly.
Work in process.
Work in process. Wow, all over the place. Which one?
Work in
Debiting work in process, right? Because all the direct cost flows into here, remember? All the direct materials, direct labor goes to this category, indirect costs goes to this one. We will be crediting wages payable, not debiting, okay? Wages payable is a liability account. When it incurs, we credit it. Okay. Now, the next few questions are based on these information. So if we take a look at these bullet points, this company allocates manufacturing overhead costs based on machine hours. So this is giving you a hint what will be the denominator here. And the second bullet point estimated 12 million machine hours, 93 million manufacturing overhead costs. Actually use the actual machine hours used is 16 million hours. So what this question is asking you how to predetermine this rate. How would you calculate this and what will be the answer? Got it right?
You divide 93 million divided by 12 million.
We have the estimated cost 93 million and we divide it by the estimated
Hours,
which is 12 million hours. What did you get?
7.75.
7.75. So meaning per hour for machines being used for this job, we incur $7.75 of indirect cost for this job. So if this particular job order has used 100 machine hours, then there will be 775 indirect costs assigned to this job. Okay, so this first question is just determining the rate how do we assign the indirect cost based on which number, which dollar amount, based on per machine hour, $7.75. The next question is also based on this information, but now it's asking you how much manufacturing overhead would Gale allocate to this job. So you had this, how would you get to this question?
Multiplied by
You
that by
would
60 million.
multiply by the actual hours incurred.
So,
So anybody has this answer?
See.
124 million. You have the rates, you multiply by the actual hours, and you will be able to get the allocation. Again, this is an estimation of the indirect cost for this job, $124 million. Next question. Here you see a table of all different types of costs incurred for this question. Again, we're continuing the previous two questions. Here it's asking you what would be the actual manufacturing overhead cost, assuming this is a year's information. Okay, what we did here is estimated the manufacturing overhead for this job. Now this is asking you if you are completing, let's say, manufacturing overhead T account, what would be the things you factor in the debit side, considered as actual manufacturing overhead cost?
What do you want? Do you want the accounts or the ends?
Tell me the accounts first.
Indirect labor.
Indirect labor, 11 million. What else?
Depreciation on plant.
Depreciation,
Machinery repair.
machinery repair, good.
Plant supplies.
Plant supplies, 6 million.
Plant utilities.
Utilities, good. Anything else? Nope. So what did you got at the end?
83.
83 million. Good, very good. So what are the bottom two?
Operating.
Operating expenses. Okay. And direct labor is a direct cost, obviously not a manufacturing overhead. All the other ones are related to manufacturing site, the cost flow between that relates to producing the goods. So we have to consider them in the third category, manufacturing overhead. $83 million. You can keep this number because we'll be using this for the next question. So remember you had earlier captured the estimated manufacturing overhead. And now what we just did is calculating the actual manufacturing overhead. So you can probably guess the next question will be, is there over-allocation or under-allocation? Okay? So next question here, if we were to close a manufacturing overhead account, meaning we want to determine whether there's over-allocation or under-allocation, how would we journalize this? We forgot the number for the previous question. The actual number is 83, and we did estimation at worth 124. So right now you have 124 here. What would be the closing entry?
I don't know the number, but I know the entries.
I'm sorry, you will.
I know like cost of goods sold, then manufacturing overhead.
So which one are you choosing here?
I think
goods sold, you want to increase cost of goods sold, right?
Yes.
Yes. But what about this number here? This is the part we assigned, right? 124. And this is the part that actually happened. So meaning that this one is actually bigger.
Okay.
So we over allocated a portion. So this is already turned into cost of goods sold, which means at the end we want to adjust it by taking some back. Right? So we assigned too much during the year, and now when it comes to year end, we want to do adjustments since the actual cost is only 83. So we over assigned it. We want to reduce cost of goods sold by crediting cost of goods sold. Okay, so this entry here will be reducing the differences, $41 million, and debiting manufacturing overhead. Okay? So think of the direction of cost of goods sold as easier to understand. You see the credit side is higher. That means we assign too much. We take some of the cost back to reduce cost of goods sold. The credit side is lower. That means we under-assigned. We were too conservative when we calculated this predetermined rate, and therefore each and every job order has two less manufacturing overhead costs. So we want to increase it. If it's under-allocated, that will be C. Okay, for this question here, we over-allocated it. Questions. The manufacturing company's management can use product cost information to do what? All of the above. Help to set the price of products, decide which ones to emphasize more, especially the ones with higher profits, and decide how to cut the production costs. So it will be all of the above. Okay, the last one here relates to service business. So if this is a law firm and they want to know the total cost of a particular job, meaning a service agreement with a particular client, what would be the main motivation when they want to know this information? To determine the fee to charge client. Because that's the service revenue, the sales revenue is the most important thing. You want to gain profit between the cost and the price. So you need to know what is the cost of the job and market the price to set the retail price. Any questions on this chapter before we move on to the new one?
Chapter 17, right?
This is chapter 17. So we're done with 16. 16, the main goal was to understand what is about managerial accounting in a general sense and different types of costs. Chapter 17, we went deeper into these activities and specifically journalized them. Post them to T accounts, understand how to calculate detailed types of the cost for each step, transfer them at the end to finished goods, cost of goods sold, do adjustments at the year end. We understand pretty much the general idea of the manufacturing flow, cost flow. So what chapter 18 is about, we're trying to refine the method that we used in chapter 17. Okay, so we talked about how to assign a cost for manufacturing overhead, but this is not a very precise and refined way to do this. Okay, why? Because we have been only using one type of allocation base for all the types of products we're doing. So this was a traditional method in the beginning. The manufacturing business just started in early years, 30 or 40 years ago. This was the original starting point of how we allocate the cost for manufacturing overhead. But later on in the 80s, people start to refine this method by using a more precise way, activity-based costing. So we're still continuing on this topic here. We're just going deeper into how to assign manufacturing overhead cost even better than before. So before we're just using a type of allocation base here, and now we're trying to be more detailed, more specific to allocate it based on different types of allocation base. So altogether, we're still focusing on how to assign manufacturing overhead costs, but using a more precise method called ABC system, activity-based costing. So the second bullet point here, after we learn the general idea what ABC is about, take a look at how managers use this information and then add in other topics like JIT, total quality management. How do these different strategies combine together help management level to set the price based on the proper information of cost for different types of products? Okay, so this chapter here, we're learning a more precise way how to do cost products based on different types of activities, different types of drivers. And we added the idea how to further cut the inventory costs by just-in-time system. And then how do we make sure that the quality of the products are proper? What are the costs we need to invest in early stages to help later on not to get to defective items, not to ship to customers defective items? So different types of quality costs that helps the business to have better control, ensuring that each stage they have products and work in process inventory that are at a certain level of quality, ready for customers. So what is this costing method? Again, this is a more accurate way to do costs, especially for manufacturing overhead costs. And the reason why we're focusing on this is, remember, because direct materials, direct labor, they're a lot easier to understand. The materials, dollar amount you purchase in, you can directly capture it into your account. You know for a fact how much incurred here. Direct labor, you sign a contract with employees, you know exactly what is the salary you're paying for them based on the hours they're working for your jobs. But indirect costs here factors in a lot of different types of costs. Utility costs, depreciations, property taxes. All of these, again, goes back to not knowing the actual cost until year end. So we want to find a way to assign these costs. And earlier we learned one method, assigning it based on a certain type of allocation base, only using one for all of the production lines, products. But here, activity-based, we'll be separating these manufacturing overhead costs into specific types of activities. So for example, if going back to, again, the Excel DVD case, maybe separating setup cost from DVD burning cost. We're separating DVD burning cost from case assembly cost. So these are different stages of the production line, and we want to capture specifically the cost incurred for this step, for this step, for this step. And we call these different activities. Okay, so if it's a business that produces crayons, you may have waxing step, mixing the wax. You may have molding step. You may have a step that does packaging. Okay, so different types of business lines, they have different activities, and we want to find a driver for these activities, which is the main factor that the cost incurred. So for example, setup costs, the more job orders you have, more setup costs incurs. Just an example up front. We'll be going into details a little bit later. DVD burning, the more job orders you have and the more DVDs are in the job orders requested by customers, the more machine hours you'll be using to burn these DVDs. So really the driver is how long you have been using the machines. These factors in the cost of DVD burning stage. Last stage, case assembly, after the DVDs are ready, put them in a case. So the more inserts you need to put in each case, the more cost incurs. So if there's a specialized DVD request that needs 7 inserts, as opposed to the regular ones just needs 1 insert, and of course a specialized per batch order will incur more case assembly costs than the regular Excel DVDs. Okay, so we want to be more precise in terms of how we assign the cost to manufacturing overhead by spreading out the different types of activities and finding a particular driver to assign the cost to. So if this product needs more setup costs, then there will be more costs here for this product, and probably less for the other type. If this product needs more DVD burning hours to produce a specialized DVD, then there will be more cost for these, less cost for the regular types of DVDs. Okay, so this is a general idea. We want to be more specific, separate different activities, and then find a specific driver to assign a cost to those activities. Okay, so other examples here, to give you more references. Shipping costs, usually when you purchase something, either from Amazon, eBay, either depends on the number of items or how heavy the item is. So this will be the driver of the cost incurred for shipping. Inspection cost, the number of times an inspection occurs in each season in your business. The more times it occurs, the more cost incurs for inspection. You need to hire experts to help you inspect the product line. So the more times you hire, you ask them to come, the more cost incurs for a quality inspection. Other examples, warranty services. The more customers come to claim problems with their products, the more service costs incurred. Okay, so we're trying to find a driver that leads to the accumulation of the cost and use that as a base to assign costs to different jobs. But again, our focus here is taking care of manufacturing overhead. Okay, because direct materials, direct labor are easier to trace, we just add them up. Manufacturing overhead will be determining estimated cost for each activity and determining the rate to multiply by the actual quantity occurred for each job. Okay, so again, let's take a look at what we learned in the previous chapter. We have the total manufacturing overhead cost, and let's say assuming that we trace it to direct labor costs. So this is an example of what we did in the last chapter. We captured the total estimation of manufacturing overhead divided by total labor cost, and then use that rate to assign to different types of jobs. It could be specialized, it could be just regular products. Okay, so this is only appropriate if this direct labor cost is a proper driver that drives the cost of manufacturing overhead for different types of products. But what if it's not? So for example, specialized DVD may require special machines, but you're not capturing machine information here if you're using direct labor cost. Perhaps the direct labor cost incurred for these two jobs are the same. But machine-wise, you're using specialized machines for this, and this is not captured here in this diagram. Okay, so a better way to allocate the cost would be to separate different types of activities, which is the focus for this chapter. We want to understand how does setup cost occur for two different types of products. How is DVD burning cost different? How is case assembly cost different? So based on the different activities we identified, we then assign a specific allocation base for those activities. So now we can properly capture, let's say there's more machine hours incurred here, then there will be more cost in the red highlighted section for this particular product. Less number of batches requested for this, less cost of setup cost for this particular Excel DVDs. Okay, so based on the different activities and how many quantity, the amounts that actually occur for different products, we'll be assigning a different cost to different types of products instead of using just one driver, direct labor cost, which is not very appropriate to capture all the costs incurred. Okay, so this is the theory portion of what we're trying to do. Let's take a look at an example here. So if you just look at the left-hand side of the table, we see that ABC steps, there's 4 of them. First step, we identify the different activities. Second step, first step after identifying activities, you estimate the total cost incurred for these different activities. Second step, we find a driver, meaning the main factor that triggers the cost accumulation for different types of activities. So machine hours would be used for DVD burning. Case assembly, how many inserts needed at the end will trigger the case assembly costs. Setup costs, the more batches ordered, the more setup costs incurred. You determine what is the driver and estimate the total quantity of those drivers, those cost allocation rates. And the third step, you calculate cost allocation rates. Fourth, multiply by actual quantity. So does this look familiar to you? Pretty much is the same idea of what we covered in the previous chapter of this portion here, right? It's just that we're doing multiple ones. We have number 1 here, number 2 right here, number 3 right here. For each activity, we go through the same process. Find a driver for it, estimate the cost, estimate the total quantity, figure out the allocation rate, and then we multiply the quantity. Okay, so really this is the same formula we use for manufacturing overhead. It's just we're doing it multiple times for different types of activities. And then finally we will add it up. That becomes manufacturing overhead cost at the end. Okay, take a look at the right-hand side. So what is that, the activity that we're trying to calculate here? The cost from? Case assembly, right? So this will be the right-hand side example I gave here, the third type of cost. In case assembly, the total cost estimated is, let's say, $10,000. So now you know the numerator for the rate is $10,000 here for this particular activity. Not for setup, not for DVD burning, just for this case assembly activity. Then we find a driver for this. What helps and what actually contributes to more cost here? So the number of inserts, there are 7 DVDs required for this specialized customer DVD sets required. And the more inserts is required for this set of job, the more cost incurred for case assembly. The regular ones just require 2 DVD sets inserts, and this cost will be lower than the specialized one. Okay, so let's assume that the total inserts required for the job is 100,000 inserts. And that means per disc you insert into the case, it costs 10 cents each. Okay, so this is the rate for a case assembly, and then you multiply the actual disc that you insert into this job. That will be the cost for this particular activity. So there were $8,000 inserts for January, this particular job, and there will be 800 costs incurred for case assembly. So for another type of job, if there is only 1,000 here, then there will only be 100 for that particular case. Okay, so this is applying the same logic as what we covered in the previous chapter, predetermining manufacturing overhead rate. It's just we're doing multiple ones. We're doing one for each activity, finding the total cost, what is the driver for that activity, calculate a rate, multiplied by the actual quantity. That's all we're doing here. Okay, let's take a look at another example. So again, the first step, determine what is the activity. Let's say we're focusing on setup costs now. Setting up the machine, preparing the software for burning the DVDs. And the setup cost is the activity, and let's say we find a driver determined by management level, it's the batches. So meaning, think of that as job orders. So the more job orders incurred, more job orders requested from customers, the more setup costs there will be for this production line. Now you know the activity, once you know the driver, then you determine the numbers. So the cost of the setup cost all along the year estimated is $600,000, and the total batch is estimated to, the orders received from customers 40 batches. But per batch, the setup cost will be $15,000. Okay, so that will be the rate for cases, the rate for setup. The previous one was the rate for case assembly. Now this is another example of the rate for setup cost. So once we know this, and the more job orders is requested, let's say for Excel DVD, and the more setup costs incurs for that particular product line. For specialized, since it's customized service, if there's only one order, then the cost incurred will only be $15,000 for this. Okay, this is just another example of another type of activity and how we capture the cost. Determine the activity, determine the driver, and most likely the problem will give you what is the dollar amount of the cost, what is the estimated batches, estimated machine hours. You need to determine the rate for these job orders and just multiply how many batches actually occurred, how many hours actually is being used for each type of machine. Okay, so it's very similar to what we covered in Chapter 17, just multiple activities. Okay, now why are we using this? Again, it goes back to the concept that this is just not enough, not precise enough for using just one type of application. Because production line nowadays is more complicated. Some portion requires manual work, some portion requires, and most likely a lot of the portion nowadays is automated. So we have different types of machines. Machine hours is incurred. If you separate a part that requires labor, separate the parts that require machine, setup costs, maybe a mixture. We have utilities involved as well to help prepare the manufacturing cycle for producing the products. Okay, so let's take a look at this example here again, DVDs, two types of products. We have Excel, we have specialized ones. If we just look at the last line, profit, what do you think this table is telling us? We just look at the last line, profit. So the sales price per DVD is $12 each for Excel, $70 each for specialty DVD per disc. And the cost incurred for direct materials is $2.40 for Excel, $4 direct labor costs. Manufacturing overhead, the cost is $1.60. Add these costs together, subtract it from sales, it tells us that per disc we're able to gain profit $4, right? What about the right hand side? $20 per DVD. So it seems like this profit is a lot higher than Excel, right? Because this is the base, we're capturing the base of per DVD's cost and its profit. But much of this information, yes.
Material price is still the same though.
Material price is still the same, direct labor is different, manufacturing overhead is a lot different, right? But let's say intuitively this company looks at this report and just thinks that this is less likely the case. Let's say they think specialized DVDs actually factors in more labor cost and more manufacturing overhead. It should be more times over Excel DVDs. And intuitively, they think this profit number is just not, this profit is just way too high than what they've expected, assuming this. So now they recalculate this manufacturing overhead. So based on this information here, we know that we're only assigning manufacturing overhead based on direct labor cost here, right? This is an example from last chapter. So we just used direct labor cost to assign the manufacturing overhead cost. And now we use ABC, activity-based costing. We're trying to understand better what's actually factoring in the production line. So we separate activities, just specifically manufacturing overhead cost, into three types, as we talked about earlier. We have setup cost, burning stage, and at the end, case assembly. So if we take a look at these, we're trying to understand better manufacturing overhead costs, separate them into three activities, and we already found the three drivers here. So let's say Excel DVD, since it's a more popular, regular produced product, there's 100,000 requests from customer orders. For specialty, there's only 500 requests from customers. Okay, but if you take a look at this now, setup cost for the 100,000 DVD sets, what is the setup cost per DVD here? This is the total cost for Excel and for specialties. If we want to know what is the unit cost, what would that be? Remember, we told you that now we have $100,000 Excel DVDs. This is our goal. We want to produce this. So how much would be the unit cost per setup?
45 cents.
It would be 45 cents. You just use 45,000 divided by 100,000, right? What about burning cost?
10 cents.
This amount, right? 0.05 cents per DVDs. We're just using all these amounts and divided by 100,000 here. Okay, because now we want to compare the unit costs between these two different products. Now the case assembly costs $10,000, and then you divide it by 100,000, this will give us 10 cents, right? Okay, so this is the setup cost, this is the burning cost, this is case assembly. So we take a look at specialty ones. Remember, specialty, we only have 500 orders here. Setup cost, 15,000 divided by 500, $3, right? What about the next one? DVD burning, 1,500. Sorry, this would be 30 for setup cost, right? And for 1,500 divided by 500, that would be $3. What about the last one? Last one, if we divide 350 by 500, give us 70 cents here. Okay, so the unit cost here for each of these, if we add them together, 60 cents for Excel. What about unit cost for specialty ones?
33.70.
33 cents, $70. So is this the same as what we covered earlier? What was the cost for the beginning ones? If we use last chapter's method, the traditional method instead of ABC, we will be getting $8 cost per DVD for Excel, right? And the other one is $50, right? Are you following this? And what we're trying to do is, if we separate the cost of manufacturing overhead into more details, we're able to trace in more detail what is specifically machine hours used for this type of product, what is the setup cost used for different types of products, and what is the DVD burning cost used for different types of products. So the detailed breakdown actually leads us to understanding that manufacturing overhead cost here is 60 cents per Excel DVD, whereas in the beginning it was $1.60 on top. And here, specialty DVD really costs us $33 in manufacturing overhead, and if we match it to the beginning table, we have $13.60 on top. So meaning that earlier, if we just used direct labor costs to capture these manufacturing overhead costs, it would be inappropriate because we haven't captured anything related to machines, DVD burnings. So this number here really is the more appropriate manufacturing overhead costs compared to the traditional methods. Okay, I know it's a little confusing right now, I see from your face. So let's just try to do an example. Okay, try to get through the concept here. So let's say this company considers using ABC costing for producing their products, two types of products, A and B, and they have two types of activities identified, also setup costs, machine maintenance. Now first of all, try to just figure out the two different rates. What is the setup rate? And what is the machine maintenance rate? Where's the attendance sheet? I should just pass it to them. setup costs. If we want to calculate their allocation rate for setup for machine maintenance, first of all, we have to know what is the rate. So how do we do calculations for these? First, if we look at setup, it tells us the cost estimated is $106,000. What about the total quantity? What do we divide it by? Divided by 200 because the problem tells us that the driver on the right-hand side is number of setups. If you look at this table, the number of setups in total is 200. Okay, so we use $106,000, the total cost of setup budgeted, divided by the number of setups, which is the driver, which is the factor of why this cost is accumulating, divided by that. This will give us $530, right? So meaning per setup, it will be $530 of cost incurred per setup. So this is the first rate. What about the second one? Machine maintenance rate, we have the total cost, $55,000, and the driver is machine hours, and we have a total of 4,000 machine hours. So per hour of machine working will incur machine maintenance cost of $30.75. So now you have the two rates. How would you allocate the cost for product A and for product B?
Multiply by how many each product uses, like the number of setups.
So for number of setups for product A, we have 20. 530 the rate, multiply 20. And then for product B, again, we use this rate multiplied by number of setups, 180. Okay? Now for machine maintenance, the rate per machine hour working, the cost incurred is $13.75. Use this as a base to multiply by the 1,600 hours for product A. Use this as a base again to multiply by the 2,400 hours for product B. Okay, so if these are the only two activities we identify here, then we add these two numbers up. We will get the total product cost. We want to calculate unit costs, simply divide by how many units at the end we are able to get. So A would be, we're getting 400, B we're getting 375. Okay, so this is just some in a more detailed sense, the table we just talked about here. We capture, first of all, the allocation rate. We have two types of activities. What is the cost for those activities? And what is the driver and the factor that accumulates the cost for those two activities? One of them is the number of setups. One of them is machine hours. So meaning the more machine hours is used, let's say for product B, you will see that the more machine maintenance costs incurred for that product line. The more setups is incurred for product B as well, so there are more setup costs incurred for product B. Okay, so once you use those rates, multiply by actual quantity, add them up, figure out the total cost for product A is 32,600 divided by how many units of outputs. You get a units cost per product. For product B as well, add them up, divided by 375, and get the unit cost per product. And these were just referring to manufacturing overhead costs. Problem here, you notice that we are using machine, we have machine maintenance costs, setup costs. So what if this problem we used the traditional method earlier, just by labor costs, for example. And if product A and product B hire the same number of employees and they work for the same number of hours, and we haven't considered anything related to machine hours, and for product A and product B, pretty much we're assigning the same level of manufacturing overhead costs. So this is why ABC is more refined in a sense that we separate different types of activities. The more it's used for this product line, the more cost incurred for it. So it's not just one single allocation base, which is less proper. It's not exactly incorrect, it's just partially correct. Okay, so this way is more proper to separate the costs and factor more to the ones that actually use more machine hours. Factor more to the ones that has more setup costs incurred. Okay. Any questions for me so far? Okay, let's move on to the second section. After knowing what this is about, how to calculate the rates, how to multiply actual quantity into the total cost of manufacturing overhead, how is this beneficial to the business? How do business use this information even further for the future plans?
To add profit.
Add profit will definitely be the main goal, right? Why are we doing this? Because we don't want to misprice the product. If we're using the earlier traditional method, we may be mispricing. Earlier we talked about specialized DVD. Seems like it's a lot profitable than Excel DVD. If that information remains in the business, probably later on the business wants to sell more specialized DVDs. But in reality, we haven't captured the manufacturing overhead cost properly. We mispriced it earlier. We didn't properly capture the cost, and therefore we thought we had a whole lot more profit going on. But in a sense, really, we haven't been generating that much profit because the cost, we captured it wrong early in the traditional methods. Okay, so doing ABC method, using ABC methods, the beneficial part definitely is better pricing the product, and we can understand, based on different types of activities, we can take a closer look at which areas where possibly we could cut the cost from. Okay, so if we want to widen the profit, it's either increasing sales price or cutting the cost. It has to be either one of these. Right? Increasing sales price unless before you underprice your product. Otherwise, this doesn't really give the business advantage because you might be selling products higher than your competitor, right? So the other way to go toward, which is usually more beneficial, is how to cut the cost. Which areas are able to cut the cost. So activity-based costing, once you take a closer look at these activities, it will be easier for companies to decide which areas they may need to adjust the cost from. This is another benefit of using ABC costing system. So again, if we go back to this example, using unit cost as a base, this bottom table here was the traditional method that we did earlier. We thought we had $20 profit per DVD sets. But then after we did recalculations on burning cost, setup cost, assembly cost, the upper table now is the more proper information represented for these two product lines. So do we have profit for specialty DVD now? No, instead of profit, we're not even meeting the cost, right? We're actually going below that. We have negative dollar amount generated. So meaning per DVD batches of orders we're selling to customer, we're actually using up our own profit gained before. We have 10 cents lower. We don't even have profit at all. Okay, because after we rearranged manufacturing overhead costs, we realized that we missed a portion of activities by using direct labor costs. We never captured this portion here. Right? So after rearranging this, perhaps the next strategy would be either increasing specialty DVDs $70 to $72, $73, so it covers the cost, or we cut the cost for specialty DVDs, or even perhaps cut the entire production line. If it's not really generating profit, there's not much request from customers either, perhaps the decision will be either cutting it totally out or increasing sales revenue if possible. Okay? So some of these decisions here depends on not just from production lines information, but also from different departments. It's a team effort to decide which areas to increase more materials, to increase the sales revenue price, or which areas to cut the cost from. Okay, let's take a look at this concept here. As we talked about earlier, these information To decide on whether to increase sales price or to decide on whether to cut the cost, this is a team effort, and in the book there's a term specifically referring to this value engineering. So what value engineering means, a team effort of reevaluating the activities that happens in the business to decide which areas we may be able to reduce costs from. Okay, so earlier we talked about two types of production lines. We thought we had more profit for this one, but in reality we mispriced specialty DVDs. So at the end, we figured that specialty DVD really isn't gaining any profit at all. So whether or not we want to cut it down the entire production line or increase price depends on information from different departments. So the marketing department needs to provide information on whether the market really needs this product or not. Is there a need in the customer side?
What if they did a recent campaign and spent like $2 million on the campaign? Do you think the company would make the decision to still keep the production line on the specialty DVD? Do you think they would do that?
That is a general question though. You said if they already spend the money upfront on designing it and researching, developing it, they have to look at the long run. Right? If this is just the beginning and they believe that this product at the end, there's based on field studies or doing surveys from customers, if they feel like there's a need in the market, in the long run they'll be able to cover the loss right now, then yes, they'll need to keep it. Right? But if it doesn't have potential later on, it might easily go outdated later, then maybe it's better to just cut it down. Even if there's a loss right now, but this will actually save the loss in the long run, even more loss later on. Okay? So this depends on how the product is being valued in the customer's eyes. Okay, it's not just as easy as right now we're losing the money, but what if later on we're gaining it back? It depends on budgeting, it depends on how well this product later on will be marketed in the markets. Right? How well the customer really needs this product. Okay? So again, making these decisions depends on different departments' information. Marketing departments, engineers, perhaps they can decide on how to design the product better using less valuable materials and having the same quality. Of course, the quality needs to be ensured because there are substituting materials that we can substitute the materials we're using right now with the lower cost, perhaps cut down some of the materials costs in the beginning or cut down some of the setup costs in the beginning. Accountants department definitely need to estimate the cost for different stages in the business. Production line, how do we do budgeting? What are the areas that potentially seems like we're using more cost this year compared to last year? Perhaps we can cut the cost of those areas. So different departments, they need to work together. Value engineering means to reevaluate the activities that we have right now and see if we could reduce the cost for the products, most likely reaching the same quality level. Okay, so by doing this, a lot of the business goes backwards, meaning that instead of producing the products first, marking up the price, and then try to figure out how do we meet target value, target profits, or target sales price, a lot of the companies now try to figure out what is customers' target price. And from the market, to figure out, first of all, what would be the approximate level of retail price that customers are able to accept. Could be based on surveys, field studies, information from possibly other companies right now. Decide this first, work backwards, minus the target profit that they want to get. Perhaps 10% of it, or 20% of the sales price, and then figure out the target cost for their production. So then this is the key point here. They're trying to meet this target cost in order to generate profit and set the price at the target price the customer will likely to accept. Okay, so the traditional method in the business, usually we produce the products first, we decide what factors in, the labor, work, hiring, indirect costs, and then we mark up a price. We decide the profit between. Then we set the sales price then. But what if this sales price doesn't meet the customer's request? What if they think this is overpriced or underpriced? So nowadays, a lot of the businesses they work backwards. When they have a new product in mind, they do field study first, understanding what's the target price customers may be satisfied with, minus the profit that they have in mind, then set the cost, unit cost per product, and try to meet this cost in their production line. Try to find the materials, hire people, of course, get machines, equipment, have indirect costs incurred that meets this target cost so they can generate this profit and satisfy customers' needs. You have a question earlier?
So that will be the customer's disposable income. That's what it's going.
Yes, we're trying to get to is the customers. The customers' needs.
Yeah, target price, is it the average price or the highest price that I came out? In other words, if they did a field study and the majority of the customer would pay $6, and you do have some customers that would pay $10, which price would they go with?
This target sales price most likely will go with the majority of the price. Right? Because some are willing to pay $10, but the majority is $6, you don't want to just target your customer with a smaller group. Right? If you price it too high, then you're going to lose, for example, the 80% of the customers and just meet the needs for 20% of the customers. So usually it will be somewhere around the average price they do, the average sales price. Yes. Okay, so this is just an idea. After understanding activity-based costing, you know the cost that flows into different activities. Companies, they strive to cut the cost, try to minimize the cost incurred here to generate more profit in between. And by doing this, a lot of the companies, they have this strategy here to field studies first, understand the customer's requested price, work backwards, minus the profit to set a target cost here, and then try to find materials, factor in labor cost that meets this target cost. Okay? Now, the full product costs, of course, we were only focusing on manufacturing cost earlier, the previous two chapters. Here, I just want to remind you that full product cost also factors in, obviously, sales costs, the operating costs all together. And so when we talk about product costs, it's not just the manufacturing side, although we have been focusing on that. It's also the part that you learn in financial accounting, administrative expenses, sales, selling expenses, delivery expenses, all of these factors in the product's cost. So just a reminder, full product cost includes both sides, manufacturing side and also the selling side. Okay, so here's an example. As we go back to that Excel DVD example there. Remember earlier that Excel DVD, the third DVD was sold at $12 each. So let's say the marketing department did some survey and realized that, okay, now customers' needs for this product is not as high as before. Likely later on the seasons, perhaps the DVDs will drop to $10 in the market on average. If you want to be competitive, obviously you need to follow this flow. You have to somehow find a way to also cover your expenses, but actually generate profit as well. So in this case, if their target profit is 20% of this $10, that means the cost has to be somewhere below $8, right? In order to generate a profit $2 and sell DVDs at $10. So this is applying the idea I mentioned earlier, understanding the sales price first, minus the profit, the target profit that you're earning, to set the cost here and try to meet this target cost value. If we match it with the current stage of what the cost is, let's say the current cost, going back to that table, is $8.10. And this is where the value engineering team needs to factor in to try to find some strategies to cut the costs in several departments in order to meet the $8 target if we want to generate 2% of the profit. So it's either not generating 2% of the profit or generating 2% of profit, trying to cut the costs in some areas. Okay? So the book gave you an example that in order to meet this $8 target, they decided to redesign the way they set up the DVDs. So the setup cost in the beginning Originally, they had the dollar amount $60,000, and now they want to somehow meet, originally the total manufacturing cost was $60,000, and now they want to meet the dollar amount $48,000 here in order to reduce the cost lower than $8. So we found a way to reduce setup cost, possibly by grouping some of the raw materials in the beginning. So instead of starting the production, trying to find raw materials from different warehouses, different departments, we may group them together as the raw materials is shipped to the business to save some of the cost for trying to collect all the materials from different departments all together to start production. So let's say after this decision is made, they do an analysis and decide that, understand that later on they're able to save the cost under $60,000. This is an estimation. So if this actually happens, at the end, you'll be able to get manufacturing overhead cost just $48,000 instead of earlier the $60,000. Okay, so this is just an example of the strategy that companies may come up with. Or they may come up with replacing materials with other types. So cutting costs for materials. Or they may decide to shift some of the labor cost into using automated process. Purchasing more machines to cut down some of the costs of direct labors. This is just one way of reducing the cost from setup activities. So let's say after this, given the numbers, you have a reduced level of manufacturing overhead costs, and you're able to reach at the end $7.98. Okay, so is this lower than $8 or higher? It will be lower. Okay, so this is an example given in the book. If you go back to read the chapter, closely following the numbers here. First of all, using ABC, we're able to identify a proper level of manufacturing overhead. And then based on the target cost, we want to meet that target cost $8 based on redesigning some of the production process. So this is an example that we redesigned the setup cost, reduced it by $160,000. At the end, we'll be able to meet the target cost by $8, and it's even lower than $7.98. Okay, so just an example of how ABC will work. Separate the activities, understand the cost of different types of activities, and then at the end, if it doesn't meet the target cost, redesign some portion of the process. This is a team effort from different departments in order to help meet the target cost.